Greetings, it is time for another worldwide monetary creation update, as we do every month. One of the most successful series of videos on this channel. So as always, we go to this Yardeni report, the links for which will be in the description box below. And this is the cumulative amount of quantitative easing by the four major central banks of the world that comprise about 90% of all the QE that is done worldwide. Not 100%, but 90%. The US Federal Reserve, European Central Bank, Bank of Japan, and People's Bank of China. Now, as you can see, the US Federal Reserve is only about 25% of the entire world's money printing. So when you hear a lot of crazy things about how the United States has printed so much money that's debased the dollar, that's ridiculous. The dollar is trading at about the same level relative to the euro and the yen as 20 years ago. No currency has been debased because they're all trading with each other within the same band. If anything, the dollar is a little bit strong right now. So ignore all that hyperbole and all the ignorant one-liners associated with that. Secondly, the notion that the United States is printing so much money that gold will go up is something that you hear from people like Peter Schiff, and that's also very ignorant because the United States is only one country, whereas gold is priced worldwide. The United States is doing 25% of the world's QE, as this chart clearly shows. So the notion that gold should go up in response to what the US Federal Reserve is doing is a tacit admission that the utterer of such a sentence thinks the United States is the only country in the world, which is also absurd. Only the sum total of these four matter, and the year-over-year growth rate ties to cumulative technological deflation. So we go to the next chart over here. Now look at this. The total is actually going down. All four central banks are tightening, which is not what they should be doing. That's why the stock market is correcting, and it's going to correct much more still. If you look at this long-term trend line, exponential quantitative easing to match technological deflation, by going in reverse, we're already 3 or 4 trillion behind where we're supposed to be. And eventually the Federal Reserve will be forced to catch up because there will be a deep recession and the stock market crash, and they'll have to do more QE than they've ever done before. And they'll match up to this exponential line again. That has happened about 5 times already. The last time they tried to tighten, they had to do more quantitative easing again. All four central banks of the world had to do more again. And the same thing is unfolding in a predictable sequence. So what is the year-over-year growth rate? This is the same chart as the one we just saw above, but on a year-over-year annualized growth rate. And I've always contended that 16 to 24% is the cruising speed of quantitative easing that has to be done just to offset exponential technological deflation. Exponential technological deflation is such that for 12 plus years, it has matched with the amount of QE, and the 16 to 24% band is one that it's barely been meeting. It's actually been below that band for most of the time. During the COVID-19 crisis, we got to 46.3% year-over-year growth in cumulative money printing, and even I thought there would be inflation at that time, but there wasn't. And that peak was February of 2021. That was 16 months ago. Now, because they have stopped printing of late, we're down to negative, minus 0.5% year over year. There has been de-printing of money to the extent that the cumulative central bank size is less than it was a year ago. Let's go back up here. This number is now lower than it was a year prior. That is exactly what should not be happening, but now we are in negative and will continue to go more negative as the central banks of the world keep tightening. Minus 0.5%, when it really should be at least plus 16. That means just to catch up, they would have to do more than $5 trillion in the next 12 months. Unfortunately, they overshoot on both sides. They overshot over here, and now they're going to overshoot on the negative side without just staying in this 16 to 24% band. And now we go to the final section, which is cumulative money printing as a percentage of annual GDP. This chart is particularly important because everyone says that the United States is printing so much money that there's going to be hyperinflation, when in fact the United States is the joint lowest of the four. The US has only done 36.3% of its annual GDP in quantitative easing over this entire 14 plus year period. Yes, GDP is an annual metric, and this is cumulative money printing across all these years, but the US is the lowest of the four. The European Central Bank has done twice as much, 67.4% of its GDP in money printing, even though you would think Germans are the people the most afraid of excessive money printing and the chance that that would cause hyperinflation. Yet they have done twice as much as the US. And the most of all has been done by Japan. Japan has done 4 times as much money printing as the US in proportion to the size of its own economy. The Bank of Japan has done 134.8% of its GDP in money printing. And nobody claims that Japan has high inflation. Nobody in their right mind says Japan has high inflation. So Japan can print 4 times as much money as the US, yet it does not have any aberrant inflation. It has insufficient inflation and still struggles with deflation. So the people who can't explain that just don't know what's going on. The reality, as I detail each month, is that this is a grand total of 4 central banks, and it has to match up to the worldwide amount of technological deflation, because money printing is borderless and technology is borderless. These two have to be looked at together in context. One central bank could tighten while the other is printing more money, and only the grand total would matter. If the grand total were flat, despite one tightening and the other easing, then the grand total being flat is the only thing that would matter. Now with this, we go to part 2 of this video, which deals with the state of inflation right now, where we burst the hyperinflation narrative that the media is pushing. So we continue to part 2. Welcome to part 2 of this video, which is the inflation update. Now, as longtime viewers know, I have put a multi-dimensional structure in place to measure inflation so that we're not dependent on just any one index, so as to avoid accusations that the CPI is rigged by the US government, as well as to avoid single country bias. The economy is a worldwide entity, and we have to treat it as such. Because to look at the inflation metrics of just one country, even though quantitative easing is worldwide, and commodity prices are priced worldwide and traded freely worldwide, is just not accurate. So therefore, we go to my 3 standard metrics of inflation, and I require all 3 of these to be above 3% before I say that inflation is higher than optimal. If all 3 were exactly 3%, I say that is when inflation is optimal. Not that it's about to be too high. This is optimal, because deflation is also bad, and insufficient inflation means technological progress is sluggish. This would be optimal. Higher than this would start to become worse than optimal. Number 1 is the US CPI, 10-year compounded annual growth rate. Is that 3%? Number 2 is the Goldman Sachs Commodity Index, perhaps the most important of the 3. Is that at a 3% 10-year compound annual growth rate? Because that involves commodities that are priced worldwide and traded worldwide. So it's not riggable the way some people claim that the US CPI is rigged. And it's traded freely worldwide, so it's very comprehensive and holistic, because oil, natural gas, gold, everything is included in that. And the third one is the 10-year U.S. Treasury yield. Now, 3% is a very low level for this, because a healthy yield curve that has a 3% spread between the Fed funds rate and the 10-year U.S. Treasury yield would involve a Fed funds rate of 0 when the 10-year yield is 3%. So the 10-year yield is the one that can most easily go above 3%. However, in a world of exponential technological deflation, you'll see how even this is pretty difficult and portends to the future about how we are in an exponentially deflationary world, and that's why quantitative easing has to be done exponentially and permanently. So what are each of these 3 metrics today? June 19th, 2022. So as usual, we will check on all 3 from the official sources. So for the US CPI, we go to the bls.gov website, which you see over here. Click on this graph icon over here. So this is the official CPI data, and let's see what it was over 10 years. So for that, we take this number, 291, divided by the number exactly 10 years prior, which is 229, and that gives us the 10-year inflation rate. So 291 divided by 229 is 1.27. 27% inflation over 10 years. What does that come out to on a per year basis? So we take the 10th root of this. I hope everyone understands the arithmetic of this. The 10th root of this number gives us the annual percentage growth rate, 2.4%. So the CPI growth rate over the last 10 years has been 2.4% a year. Sometimes lower than that, sometimes higher than that, but the average annual growth rate has been 2.4% a year. Right now, for the last 1 year, it's been higher than that, but we have to see this in the context of a 10-year moving average, because short-term fluctuations get smoothed out. Look at this 1-year annual growth chart over here of the CPI. There's people who screech about how it's 8% higher than last year, but they don't look at all the 9 years before then, when it was close to 0 in early 2020, or 0 for almost all of 2015. The average is 2.4% a year, which we just saw. And yes, it's high right now, 8%, but it's already peaking, and it takes a lot for this average to get above 3%. So this was the CPI. Now we go to the next metric, the Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, the links for all this will be in the description box below, of course. So the 10-year compound annual growth rate of the Goldman Sachs Commodity Index is 2.61%. That is higher than before. It used to be negative for a long time. Now it has risen to 2.61%, and that's approaching 3%, but it's not quite at 3% yet. The United States has deliberately chosen to halt domestic oil and natural gas production, so the price of both of those has risen a lot, and that has unfortunately boosted commodity prices, but it still is not high enough to be at 3% a year over a 10-year window, and the demand destruction that oil is facing right now is just immense. So this is very, very hard to boost into high inflation, certainly in the high-tech atom age. So 2.61% for the Goldman Sachs Commodity Index. Now we go to the third and final metric, which is the 10-year U.S. Treasury yield. This is the 10-year U.S. Treasury yield, and 3.24% is the yield. So yes, that one is above 3%. Now this is the 5-year chart that shows how rarely it's been above 3%, only for a few days in the last 5 years, and it quickly plunged after the fact to be much lower, and I suspect the same thing is going to happen here, because when this yield stays too high for too long, the real estate market crashes, because the Federal Reserve has cornered itself in that it buys only treasuries like the US 10-year treasury and mortgage-backed securities, and you can't have low rates forever and ever, because the amount of assets you have to buy to sustain those low rates rises exponentially, and that market ultimately shatters. It's very obvious the Federal Reserve has to send money directly to people. They just have ideological resistance to that, which is going to cause a lot of hardship for people before the PhD economists come to the logical and necessary conclusion, which I wish they would come to without all this turmoil, but they're not going to. So the 10-year U.S. Treasury yield is 3.24%. That one's above 3%. So now we go back to our table. U.S. CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and 10-year U.S. Treasury yield, 3%, 3%, 3%, are the thresholds that I have consistently set forth. So what are the readings this month? 2.4% for the U.S. CPI, as we saw, 2.61% for the Goldman Sachs Commodity Index, 3.24% for the 10-year U.S. Treasury yield. One of these three is above 3%. The other two are not yet. They are rising though, but I do need all three of these to be above 3% before I say inflation is higher than optimal. Not in a crisis mode yet, but higher than optimal. Optimal would be for all three to be exactly 3%, because that's when you have the maximum amount of technological progress in relation to the least amount of pain for average people. And before anyone pipes up and says deflation would be good because deflation means that people would pay less. No, deflation is far, far, far worse for people than moderate or even slightly above trend inflation, as I explained in this video, which is in the tile in the right-hand corner up here. So spare me the lecture about how all inflation is bad and deflation is good, because that is one of the most ignorant things that a person can say. Of course, saying such a thing is a fad, because everyone wants to sound knowledgeable on this subject, and relatively few people are, and therefore there's a tremendous amount of misconception and miseducation about this topic. But that was the inflation update. I hope you found this informative, and a welcome dash of truth that counters the scaremongering narrative of the mainstream media. But the Federal Reserve should not be increasing the Fed funds rate, nor should it be unwinding quantitative easing, because that will cause a stock market crash, which is already underway to some extent, and they will simply be forced to resume quantitative easing again. If you like this type of content, I encourage you to hit the notification bell and subscribe to this channel. Thank you very much for watching.